Welcome to the Tippy Top Entrepreneur Experience. Toby Lywood from Ox, great to have you on the show.
Thanks for having me. It's a pleasure to be here.
No, great. Thanks, Toby. And now, like a few other guests on the show, we actually met at the Mountside Ventures summer party back in 2021, which was definitely, I thought it was the highlight, and it was definitely the highlight of my 2021. So great seeing you there. And just for the listeners' benefit, there's a lot of people in VC, and a lot of them are all talk, but Toby actually walks the talk, and he's got a very unique story about his journey into venture capital. Toby, would you like to share that with us?
Yeah, sure. Happy to. So I've been an investor at a fund called Ox now for about 2.5 years. But before that, I actually came from a financial due diligence background. So not quite auditing, but not on the more interesting side. I did a history degree at university because I really like history, but I realized that that's probably not the most helpful way to get into venture and startups, which is what I ultimately wanted to do. So I thought I would get a more solid grounding in some hard skills. So I joined EY in the financial due diligence team and spent 3.5 years qualifying as an accountant and doing FDD on a mix of software transactions, fintech, telco, bit of real estate, kind of you name it, I had a look at it and did some financial due diligence on it. So I did that, and then I took a bit of a gamble and a bit of a pay cut, and joined Ox as an intern to get my foot in the door in VC. And fortunately, I've been there ever since, and kind of loving what we do at Ox. Just for people who don't know, Ox is a B2B software focused fund. We invest at what we would call the scale-up stage, or the go-to-market fit stage, or the early growth stage, whichever you prefer, which loosely translates at the kind of Series A stage and beyond. And we invest in companies across Europe and Israel.
Great. No, it's great to have a Series A investor on the show to talk us through that portion. And I think I'd like to reflect on your journey, say it just shows the passion that people have for this industry, that go to great lengths to get in, because it's just so exciting. And most people in the industry are so excited to work with entrepreneurs that they'll do anything to get in. And so very inspiring, I must say.
Yeah, I think the best thing about venture actually is that people come from all different backgrounds, like you said. And it's ultimately passion for startups and investing in startups and helping them grow that enables people to get into venture. And I think it's great that there are opportunities now increasingly with initiatives like Diversity VC to bring more people into the space.
Yeah, absolutely. Well said. Great. So 3 main topics for today: the art and science of how to approach investors, product market fit, go-to-market fit, and growth and moat stages explained, and then how to internationalize your business without ending up in the notorious graveyard. So sticking with 1, the art and science of how to approach investors. Now, before we dive into the how and what, do you perhaps want to talk about the why? Why is it so important to make a good first impression with investors?
Yeah, sure. And I think the biggest thing here is it stems from the fact that, VCs have the huge privilege of being able to look at and assess countless numbers of businesses in a given year. And that's the positive side. The flip side of that is that investors need to make relatively quick decisions on whether or not they're going to proceed and go into kind of greater depth with a company in regards to investing in them. Because of that, I think you need to think about how investors might be qualifying out opportunities. Many investors have very narrow scopes for what they invest in. So for example, Ox, we only invest in B2B software companies. So, if off the front of your deck, you say we're a B2C company that has a hardware device, then, we're not a good fit for you. And I think being very transparent and kind of open about that, saves time on both sides actually, and will allow people to find better fit investors. I think that's one of the first things I would say, is just make it very clear kind of what space you sit in, what stage you're at, what geography you're in, all the kind of key things that VCs might be kind of qualifying an opportunity in and out. So that's the kind of first piece I would say. The second is unless you're in a space that is kind of very technical or very vertical specific, it's absolutely crucial to be able to explain to investors, what you're doing, how it helps people, and why you're doing it. Those three areas are absolutely critical. And I'm not particularly technical, so if we're looking at a deep tech company, I might refer to one of my colleagues who have more of a technical background. But ultimately, particularly within something like B2B software, you're typically selling to people who aren't, technical, unless it's a kind of developer tool. And so you need to be able to communicate it pretty succinctly, what you do and how it works. That kind of comes across, sales collateral, marketing. You need to be able to grab people's attention and say, look, we're solving a problem that you have. And that applies to VCs as well. We need to understand what they're doing so we can see it in the context of what we know about the market and how the solution fits. I guess the other thing to do is, VCs are backing people as much as they're backing companies and ideas. And having a good first impression obviously helps set the tone for that relationship, which if companies are invested in, it's a very long-term relationship. And so having the right impression, having good attention to detail, making sure there aren't kind of obvious errors in your deck, that's a crucial way, I think, of kind of saying, look, I'm a conscientious person, I think about things, I'm on top of things. It's not the case that you need to know, absolutely everything about your business. If there's someone asks you some obscure metric about one segment of your customer base, it's fine to say, I don't know. Actually, it's worse to kind of try and obfuscate and say, actually, it's this and this. Just say, I don't know, and I'll come back. And, people aren't expecting everyone to be on top of every facet of their business at once, but just having that kind of openness and being willing to say, look, I don't know what that is, but we can come back to you and follow up with a data request, I think is crucial.
Yeah, no, well said. And now following on from that, talking about the pitch, we've said that, pitching is about a little bit about selling, a little bit about storytelling, but the best kind of story is the truth, because it will come out, as to which Elizabeth Holmes will attest. Now, how do entrepreneurs strike that balance between making it alluring but still not getting caught up later down the line?
Yeah, I think one of the things is just being really enthusiastic about the space you're building a product in. You need to kind of show your enthusiasm for that, and that will come through in your pitch. So just being really immersed in the space, really passionate about what you're doing, the problem you're solving, having had it, maybe experienced it yourself, or you've spoken to lots of people who have experienced that problem. So just being able to kind of say, look, this is the problem we're solving, and this is why we're excited about it. That's kind of, that will come out, just through the truth anyway. I think, you mentioned earlier that transparency is critical, and I think it is. VC relationships with companies are long term. Everyone likens them to a marriage, and I think that's pretty apt, actually. There's work together closely, intertwined finances, all of those different elements that make it very much like a marriage. And so transparency at the front, at the beginning of the process is critical. Within VCs often talk about the first board meeting as the oh gosh, for want of a less rude word, meeting, and where some of the skeletons in the closet come out. And I think that's true, and that's always going to be the case, even if you have the most transparent relationship. But you can minimize those, and that gets you off to a good start. I think where companies should kind of where it should go towards the more optimistic side is when they're talking about the vision for the company. I think that's where you can really kind of be a bit bold and a bit kind of excited about the space, and kind of sell a story that ultimately might not come to fruition just because the market moves, or you haven't kind of achieved exactly what you wanted and been able to execute on it. And I think that's where kind of entrepreneurs can really sell, look, the market is this big, we see ourselves as this, we're in this vertical at the moment, but actually maybe we're kind of doing marketing data automation. But actually, in the future, we can move beyond marketing data, and we can do kind of other areas, so sales data. And then maybe we go on to HR, and then actually, ultimately, we can be the kind of data aggregator for data across an entire organization. And so that's where the kind of selling comes in. And you're not saying anything untrue, because you genuinely have those ambitions. And VCs can get excited about it with you or not. And they'll probably have their own assessment of what's realistic. And it probably is not the same as what you're saying, but that's fine. That shows that you have a vision that extends kind of into the future. So that's where I'd say that's where you kind of tip the balance between kind of storytelling and selling there.
Yeah, wise words. Now, going back to the data side of it, you mentioned earlier you've got a background in financial due diligence. So you've probably looked at data, analyzed it, and cut it in more ways than we that we even know is possible. In terms of pitch decks, people can get quite creative with the ways that they cut the data and creating a little bit of optical illusion. What are the rules of the game?
Yeah, I think, going back, and you'll probably hear me talk a lot about this, clarity is the absolute most important thing when it comes to data. I see companies with a year end that's not obvious, so not kind of ending at the calendar year, so like December. If that's the case, label it, because otherwise it's very confusing and investors start going, this doesn't add up. I don't understand. You said you're at this level of run rate revenue, but actually this chart shows this. I think that's a very kind of easy one. Similar, if you've decided to change how you think about what's included in costs of goods between one year and another, and so there's a weird kind of fluctuation, that's another one. Just clearly label it. A kind of particular bugbear of mine is people who have cumulative revenue. So they say, in this year we made $1 million, this year we made 2 million, so our cumulative revenue, and they show the cumulative revenue of 3 million. It's like, oh wow, that's huge. But actually then you realize it's just kind of stacked on top of each other and doesn't actually show real growth. So those are things to avoid. I think in terms of things that you can think about to present yourself in a better way is think about fitting the data to the story you're telling. So for example, maybe you're a business that started selling to SMEs. You had some early traction there that allowed you to build out the product. And now actually you're moving towards the mid-market or even to enterprise, and you're selling to enterprises now. If you look at that customer base and the customer data as a whole, the growth might look low. You might have kind of higher churn than people would expect, given that you're now pitching a company selling to enterprise. So what you can do there is split out the enterprise sales from the SME sales. And you say, actually, look, we're deliberately churning out our SME customers. They're no longer a good fit for what we're trying to do. They don't make sense kind of from a unit economics perspective. So, over the next 6 months to a year, that revenue, maybe it's substantial right now, is going to go down to very little. But actually, what we're really excited about and what we're proving and what we're kind of basing this investment on is the enterprise segment. And actually look at that, we're flying. We're absolutely killing it there. The retention rate's really good. The churn is practically zero. So actually, on balance, the story might not look great, but actually, if you look at the segment that they're focusing on, maybe it looks really good. And you can do that, by size of customer. You can do it across different verticals. I mean, another thing is, companies are increasingly looking at dual go-to-market strategies. So, there might be an enterprise strategy and then a product-led growth one, which is kind of trying to drive user adoption and then kind of upsell from that process. The unit economic behavior of those customers will be completely different. And so you should present them differently and not on a blended basis. And you can say, look, this is an experiment we're doing. We're kind of proving that it works. And we're looking at the unit economics. This is not kind of 100% of our efforts, but it is having an impact on the overall metrics. But, if it works, then it's great. And if it doesn't, then, we'll go back to kind of whatever we know best.
I was going to say, I'd like to meet that founder. Sounds like they've got a nice, healthy mix of entrepreneurship and also just protecting existing revenues. I like that. Now I want to move on to question bank number 2. So we've got product market fit, go to market fit, and the growth and moat stages explained. Now most people have heard of the product market fit. Most people have heard of growth and moat. But if you're anything like me, you hadn't heard of go to market fit. What a great thing. I think let's not assume that anyone's heard of anything. Do you want to start it from the beginning and take us through that journey then?
Yeah, sure, absolutely. So I think, the first thing to note is I'm kind of borrowing heavily from the work, lots of work that other people have had on this, including on the kind of go-to-market fit stage. I think one person I would really reference in that is Mark Roberge, who, if you don't know, was a kind of early employee at HubSpot, and he was responsible for building up the sales team in his 9-year tenure as CRO there. He wrote a best-selling book that I would highly recommend for anyone who's kind of interested in this space, called The Sales Acceleration Formula. So a lot of the thinking comes from that. A lot of it's from what we see ourselves at Ox, and I'll kind of blend those together. The other thing to note is, we have a very specific focus on B2B software. I think a lot of that, what we would say, is applicable to other companies and other spaces as well, but that's a caveat just to kind of kick off. So starting with product market fit, I think essentially the way to think about this is when your value proposition and the needs of the customers align. There are lots of definitions for this. You can look them up and there are literally countless definitions. But essentially, for us, it's about winning strong cohorts of early adopters of your products and retaining them. And retention is absolutely critical to understanding product market fit. If customers are willing to pay for your product and then continue to pay for it, it demonstrates that they're getting value out of it. And that is essentially what product market fit is. There's obviously a bit of an issue here because the pace that companies are growing at the moment means that sales is a helpful leading indicator, but you're not going to see those renewal cycles. Sometimes, it might be an annual renewal cycle. Sometimes it might even be multi-year. So you need to think about leading indicators about, how you can kind of assess that the customers are getting good value out of your product. I guess if we try to put some metrics to it, an approximate ARR range for product market fit is kind of $0 to $3 million. There are different, think of that as a sliding scale rather than a kind of fixed thing. We see companies that I would say hit product market fit at around $1 million. Some do it earlier, some do it much later. Typical round for kind of product market fit is angel seed rounds all the way up to kind of early Series A. And as I mentioned, the kind of target market there is the early adopters. So next up would be the go-to-market fit, which is probably, as you mentioned, less well known, certainly kind of getting increasing traction within the SaaS community, but kind of, I think it's applicable outside of that. So once you've achieved product market fit, the next challenge is to build a predictable and efficient growth engine. It's about unlocking your company's growth potential by scaling revenue generating activities, all while doing that in an increasingly predictable way and with good unit economics. So a critical one that we look at there would be CAC payback. So how long it takes you to pay back the customer acquisition cost for individual customers. I think another one that a lot of people will talk about is LTV CAC payback. So looking at how much the customer acquisition cost is in relation to the lifetime value of the customer. There are different kind of debates around that. My personal one that is, most companies at that stage aren't old enough to have customers, to really understand what the lifetime value of a customer is. You can achieve it, you can look at it and assess it mathematically, but actually it's not going to be as reliable as actually seeing the data. And so we tend to look at CAC payback more than LTV CAC ratio. That's a personal one for us. Another issue is, looking at retention rates. And if a company has, negative net churn, i.e. they're kind of getting more revenue from their existing customers than they're losing, that might be because they're upselling lots of them, but also churning some. You can't calculate a lifetime from that because they have an infinite lifetime, because the overall revenue is growing more than it's shrinking. And so calculating an LTV there, even mathematically, doesn't make any sense. But kind of going back to more characterizing the kind of go-to-market fit stage, it's really companies with from around $2 million to $20 million of ARR. And again, there's flexibility on this. I've seen some really impressive businesses achieve it sooner than that. Typically, that tends to be with smaller customers, so they can prove that they're selling consistently to different customer bases, and actually that they've got some level of internationalization already, because then it shows that it's applicable across geographies, essentially. In terms of the rounds that you're looking for there, it's typically kind of late Series A to early Series B rounds. Obviously, the kind of funding market is quite interesting at the moment, so kind of anything goes right now, but that's where I would kind of position it. And in terms of the customers you're looking for, it's kind of the early majority of customers. So going in a bit more detail, it's about identifying new customers, reaching them, selling to them, onboarding and upselling them in an economically viable way. That's when you can prove your unit economics are scalable and that you're kind of able to break out from these early evangelists into mainstream sales. And that's go-to-market fit. There's lots of ways of looking at it, but that's kind of how we would think about it. And then finally, there's the growth and moat stage, which you referred to earlier. So that's typically when a business has reached over $15 million of ARR and your go-to-market playbook is working. The key elements at this stage are, continuously recruiting at pace, so kind of keeping up that scaling journey, as well as preserving a strong culture, and then also kind of building out and creating a distinctive brand. The main goal of this phrase really is sustainable revenue growth. And the rounds here are kind of a late Series B to a growth round, and the target market is the mainstream, or basically anyone that you haven't touched so far. And you can do that across multiple geographies, and that's where you can tend to expand into other geographies in a major way.
Great, loads in there. I've been writing a lot. No, fabulous. Now, something you mentioned in there, you talked about the leading indicators, and that a lot, I know you've historically mentioned that there's a lot of lagging indicators, and churn being a lagging one, so you can't actually work out where you are in the cycle. What are some of the leading indicators that we can latch onto?
Yeah, sure. I mean, it really depends on the product and the user personas and the use cases. So there's no kind of one size fits all, as is the case with most things you look at when it comes to SaaS businesses and actually other types of businesses as well. I think fundamentally it's about understanding that your customer is getting value out of the product. So you need to think about ways of doing that. I think engagement is probably the best proxy. And there are different ways of thinking about how you can measure engagement. So yeah, I would come back to Mark Roberge's work on here, and he actually has a formula for this. So he talks about the percentage of customers doing events, a number of events within a certain period of time. So to give it the context of an example, it might be having 75% of customers of Zoom make 5 calls within their first week of signing up. And that for them would be a good leading indicator that they're getting value. And obviously you can look at this over a period of time. There are other ways of doing it. So you can look at NPS score, and looking, that's more tricky because there are different NPS scores for different sectors and different verticals and different use cases. Drawing off the NPS work, you can also just do customer surveys and say, how would you feel if you could no longer use our product? And if, a decent proportion of your customers are very disappointed, that's a good indicator. It gives you a feel for the proportion of really evangelical users who are going to give, strong word of mouth, and continue using it and championing it within the company they work. And then obviously you mentioned the kind of more lagging ones, which are the kind of logo retention and also the kind of net revenue retention. So how much you're able to sell more of what you're doing to existing customers.
Great, no, thank you very much. Now, switching tack slightly, I think we always say in terms of where you are in that journey, there's a time to experiment with things like inbound marketing versus outbound, and there's also a time to consolidate and where growth is the most important thing. Can you talk us a bit through that?
Yeah, I think a helpful analog here is thinking about minimum viable product when launching a go-to-market strategy. So in this case, you start with an idea and then you test and iterate it on it. So this isn't kind of something you do at scale. You're not kind of saying, look, we're going to try this approach and we're going to throw all our resources at it, because obviously that doesn't make sense. And that's a fantastic way to burn through a lot of team time and funding and everything else. And everyone comes out of that frustrated. So it's about doing continuous kind of focused experimentation that you can back up with data. So you really have to be on top of measuring the data when you're doing this experimentation. And then once you've got it right, then you can kind of double down and you can, scale up resources behind that. I think winning early customers and finding product market fit is a critical milestone for startups. And finding product market fit alone won't, unlock consistent, reliable growth. And so we often see SaaS businesses trying to invest heavily while on shaky foundations. So I think, it's about not trying to scale too quickly and jumping to that growth phase without having the right understanding of what go-to-market motions fit in place, basically. It's always a trade-off, right? You're trying to expand as rapidly as possible and capture the market opportunity. but you need to make sure that you're not pouring investment into a broken go-to-market machine. Channeling investment into a leaky funnel will just lead to much worse outcomes than, iterating and saying, okay, did this work in this market? It didn't. Okay, maybe if we tweak this and we say, tweak the messaging here, or say we're focusing on this use case to this set of customers. It's really about experimenting. And it obviously depends on what you're selling and who you're selling it to. But that's how I would think about it.
I like that analogy of the go-to-market machine. You can just imagine a machine and you're putting in the fuel here and it's, turning the crankshaft, which is the ARR that comes out the back, but quite a lot of tuning that goes into it. You mentioned scaling there, and I think that's the precursor to then looking to go international. And I think that's one of your and Ox's USPs, is how to internationalize. And I think we've all seen it before, that businesses raise X round, they expand into the US, they make a lot of expensive hires, they burn through all the cash, and they end up coming back with their tail between their legs back to Europe or the EU. Now, what's the most important lesson here? And I'm sure there are lots, but what is the one thing that entrepreneurs need to think about?
Yeah, so I think one thing I'd start off with is it's interesting now that there's such a booming market in Europe for scale-up stage software businesses, especially, but also businesses across other spaces, that actually businesses are really heading to the US later than they used to. There's a great report from Index Ventures that shows that the proportion of businesses moving to the US before their Series A has fallen from 2/3 before 2013 to just 1/3 since then. So actually people are thinking about making that transition later because there's frankly a larger market opportunity in Europe. And that's going to come on to basically the question there. Moving particularly to the US is one of the toughest choices in the life of the company in terms of timing. If they do it too soon, then you risk spreading yourself too thin, you fail in the US, you lose your position in Europe, and that's obviously disastrous. But if you do it too late, then perhaps you've handed a US competitor market leadership. And then actually, because of the funding available in the US particularly, then maybe they'll come and challenge you in Europe too once they've dominated there. So you need to make sure that the decision makes sense. There are examples of companies that have actually done really well by never going to the US. I think iZettl's a really good example. It's a POS payments company based in Sweden, and they raised a huge amount of money and expanded to Europe and Latin America, but actually never went to the US in a substantial way. And they were acquired for $2.2 billion. So that's an example of a company that actually didn't need to go to the US. Another thing to note is, US investors are really increasingly active across Europe, and actually European investors are increasingly sophisticated and specialized. And so, you don't necessarily need to go to the US for funding purposes, because if you're a really strong company, a lot of those US investors will come to you. So there are a lot of things to think about as to, do I actually need to go to the US right now? Is there a real kind of need for me to do that? But when you've come to it and you decide that actually, fundamentally it makes sense for this business to expand there, then it's around the timing, basically. So if you go too early, then perhaps you're still refining your value proposition. You've had early growth in the home market, and you've decided to expand to the US, and then you realize there's actually an issue with the core product because it doesn't translate in the same way to the US. And that's much, much harder to fix when the company is spread across multiple countries and it's not ready to. So you've got to really think about what could limit you. So perhaps it's the value that customers get out of your product is completely different in the US. Maybe it's the customers in the US buy in a completely different way. Maybe you need to have certain integrations that don't make sense in Europe, and actually without them, your customers in the US won't buy. There's honestly, the list is pretty much endless. There could be different regulations. You might need to think about operations, how much of a presence do I need to have there? So those are really kind of ideas for essentially thinking through whether or not you should go. And I think that's the biggest thing. You just need to make sure the timing is right. And it's different for different companies. And actually, sometimes it makes sense not to go there at all.
Yeah, no, it certainly doesn't seem like an impulse decision. You really have to speak to people who have done it, do as much research as you can, and be ready for it. I think, often you see companies internationalize and they do it, but when you're working on multiple versions of the code, multiple languages, you end up burning out your team, you get high staff attrition, and that's the beginning of the end. So yeah. Now, in terms of the strategy, you've mentioned that there's 5 models of internationalization. Care to share and describe the pros and cons of each, if you can do, in a few short words?
Sure, I'll try and be brief. This is a topic I could go into in a lot of detail. So, contrary to what I was just talking about, the first strategy is go straight to the US. This works really well for well-funded software businesses, particularly with early evidence of strong product market fit. The advantages here are, huge market in the US. There's a mature funding ecosystem, although, as I mentioned, that advantage is kind of being eroded by the increasing internationalization of the US investors. And there's a pretty dynamic labor market, although it's expensive. I guess the drawbacks for that is, it typically requires a founder relocating to the US for, on a full-time basis, and there's a lot of reasons for that. Competition then absolutely ramps up because, you can be a market leader in Europe, but actually, if you're in a hot space, then there could be a number of competitors that are out there to eat your lunch in the US. I think a couple of examples of companies like this would be Zendesk, Stripe, Datadog. They're all good examples of companies that have done this successfully. The second strategy is going adjacent first. So this is a bit of a lower risk option, and it basically is expanding stepwise into geographically nearby territories. So, if you're in Germany, maybe you go to Austria, and then you go to other countries in Europe that are close by, essentially. The advantages to this is it's obviously de-risked. It's easier to iterate the go-to-market strategy because between such proximate countries, it's likely to be slightly less drastic than it is when you go to the US, where it could be completely different. It's less expensive, and actually, because of time zones, it's easier to manage remotely. The kind of drawbacks of this approach are the opportunity cost. You might be losing time in the US that you can't afford to lose, and actually maybe it means you're only going to become a European player, and then you'll be acquired by a bigger kind of US competitor. And there's kind of unfilled potential in that. There's also a risk of slowing down product development, actually, because if you're, by far and away the leader in Europe, you might not have as much of an incentive to develop some areas of the product as you might be in the US, where you have lots of competitors who are kind of pushing, and you're pushing to get new features out and kind of figure out what customers want. And so actually you can end up kind of taking the brakes off a little bit in terms of the product development and being slightly less hungry because you don't need to be the leader in Europe. But then, there are companies that have done this really well. UiPath is obviously one that people have seen a lot about recently. Unity is another, and Mimecast would be a great example as well. So onto the third strategy. This is thinking around the kind of team and business model contingent. So some companies have discrete reasons to prioritize non-obvious regions. And it might be due to team location or due to the business model. The advantages to doing kind of non-obvious regions is it might be, for this company, it's the most highly predictable expansion path. Maybe you're in a legal tech company and actually you're based in the UK, but you want to go to other countries with a similar legal system because it makes sense with the framework of what you're building that you need to kind of target companies, customers in countries with the same legal system. So you go to Australia, for example, which seems like an odd fit because it's a big country, but it's not as big as the US, and it's as far away, so it's kind of challenging to serve there. But that's why people go for that. And so another advantage for that would be kind of embedding geographic defensibility, because again, you really understand whatever it is about that market, and it's similar to your home market in that way. And allows you to kind of build a moat there. The drawbacks obviously are kind of smaller addressable market size. I don't think it's controversial to say that in the example I gave, expanding to Australia gives you a smaller market size than expanding to the US would. I think that's pretty obvious. There's also a risk of concentration in terms of your customer base. And actually, there is a bit of a risk around funding because, companies expanding into the US typically seem like a kind of bigger investment opportunity than perhaps expanding to a less known or less sizable geography. But there are good companies doing that. Ayuden is a good example. Personio is also another one that have done that successfully. The fourth strategy is pursuing a globally distributed model. So this really works for generic horizontal software tools, particularly with inbound lead generation motion and self-service onboarding. And those sort of businesses can be global from day one. They're serving people who they've found a problem for. It doesn't matter who's kind of buying it or where they're buying it, as long as they can use the tool, set themselves up remotely, then this is a good model for those sort of companies. The advantage is obviously you have immediate access worldwide. It's a low touch sales model, so it can be quite cost efficient from a sales perspective, and you have a huge addressable market. It's global. The drawbacks to this would be, it's challenging to prioritize leads. You do need to think about adapting the product to local needs. And so there's a challenge there, because if you're global, then you have to figure out which ones to prioritize. And then you also have to navigate time zones and language issues. So there's a lot around that. And so localization becomes very important there. I guess a couple of good examples of that would be HubSpot, Pipedrive, and Typeform. Actually, they're all good examples of that sort of business. And finally, the final one is kind of inorganic. So that's where you utilize M&A to basically, bring in a local expertise or branding or operations by acquiring businesses in target geographies. Advantage there is obviously it's a shortcut to building a team out in that geography, and you can kind of acquire intangible assets pretty quickly. So that might be regulatory permissions. So you acquire a business because it has a license to operate in a certain geography, and so by buying that business, you can then operate in that business without having to go through that process yourself. Downsides of this is expensive in terms of cash or maybe dilution, depending on how you structure the deal. And actually the post-merger integration can be very complex. And actually we've seen businesses lose a lot of time and kind of focus by going through that integration process. And actually the value that they've added at the end of the day is not what they thought. Maybe they actually had overlapping customer base. And so the total number of customers is actually reduced, perhaps.
Super.
So those are the 5.
Wow, that's quite a mouthful. Okay, so I think let's pick the US expansion because that's the favorite one, and that's often seen as the holy grail of expansion and then exits. In terms of what entrepreneurs can expect on the ground, what's it really like?
Yeah, I think a lot of entrepreneurs have this perception of the US as a kind of fabled land with, legendary investors lurking around every corner, waiting to give them investments. I think the reality is, in many ways, the US is seeing the same challenges that we're seeing here, it's only kind of exacerbated. So, hiring in the US is really expensive. Actually, it's harder to retain employees in the US as well. So there are challenges around that people need to think about when they're going there. You need someone there to import the culture of your business. And that's why, as at Ox, we often say that someone in the founding team or a kind of founder-like person has to move to the US, because it's critical for them to really give a sense of the business, but also have the flexibility to understand what the US market needs. The biggest thing that we also say is it's pretty crucial for businesses selling in the US to look like a US business. And so that kind of engenders trust amongst US customers. I think something we also see that quite commonly for entrepreneurs landing there is, they have these really great reference customers from Europe. And, a lot of Americans haven't heard of those companies. So they go, oh, look, we sold to this multi-billion-pound revenue company. And, they speak to a US customer. Oh, well, we don't know who that is. And so really what that speaks to is the process I spoke to earlier, that you basically have to go through that go-to-market fit stage again. You have to start experimenting, and you have to do it in an iterative way. So you have to say, actually, perhaps this particular use case doesn't make sense here. And so I think the biggest thing to take away is it's a learning experience. It's not you get there and you land on your 2 feet and the business is kind of flying. You actually need to do a lot of experimentation to get your go-to-market working there. Maybe it's around how you sell, maybe it's around what person you're targeting. Maybe the customers you sell to have a completely different kind of hierarchy and structure. And so the person you sell to in Europe doesn't exist in the US. So I think it's really about expecting the unexpected and being very flexible, but also kind of obviously maintaining the integrity of the culture that you've built and also the kind of the value of the product.
It feels like starting a new business, like, okay, I'm going to do a new entrepreneurial venture.
Yeah, I honestly think that's a good way of thinking about it. And it's that the level of preparation that you have to put into going to the US is literally like starting a new business. You know, it needs to take time. You need to budget for hires. In many ways, it is actually like setting up a new business.
Wow, very insightful. Great. I'm going to go back down memory lane to the beginning of the podcast and start summarizing. So I've got lots of notes. So here we go. So back to number 1, the art and science of how to approach investors. Toby said, tailor your deck to the sector and stage of VCs that you're approaching, help them do their job, help them sift through the decks, and then yours will probably get more attention. For instance, B2B SaaS, Series A stage, boom, okay, you're going to get someone's attention. In terms of VCs and the storytelling, remember that they're backing people, not just a business idea. And so your first impression really does count. Make sure there's no errors in the pitch deck, otherwise you're really getting off to a bad start. In terms of storytelling, be passionate, but be transparent. And if you want to talk and get really excited about vision, that's fine. That's the bit where you might, investors may not agree with you, but that's what they like to see. And that's when you can really let yourself, come up with some very big ideas. In terms of data, Toby's an expert in that. And I think the number 1 rule here is make the data very clear and fit it in with your story so that it all tells the same story. There's too many decks I see that are, 5 different stories in one. Make sure it's coherent and, heading in one direction. Question bank number 2, product market fit, go-to-market fit, and growth and moat stages explained. So in terms of product market fit, what is it? Well, it's when the business value proposition aligns with the customer needs. Typically, you see this 0 to 3 million ARR, but usually around $1 million ARR, annual recurring revenue, of course. Now, go to market fit, how do you know? Well, that's when you've got a predictable growth engine with good unit economics. Some of the key metrics to look for are the cost of customer acquisition, payback period, CAC payback, or the lifetime value of customer to cost of acquisition ratio. And there's a lot of debate about that. Do your research on that. Growth and moat stages. How do you identify that stage? It's typically when you're continuously recruiting at pace and you've got sustainable revenue growth and of course a strong brand, and that's more like 15 million ARR. And the prior stage, by the way, was 2 million to 20 million ARR. Now, in terms of how you know where you are in this stage, yes, you can look at the ARR, but that's often a lagging indicator. Look for leading indicators in terms of customer engagement, how they use your product, and of course, if you can get that, an NPS score. Now, advice in all these stages is don't try to jump from one to the next too quickly, because you might end up burning a lot of cash. So there's a bit of competitive tension there in terms of getting your fit right before you scale, and of course this overwhelming pressure to go faster and compete. Just make sure that everything is grounded in science as opposed to just gut feel. Now, a big topic here, how to internationalize your business. Topic number 3, without ending up in the graveyard, of course. Now, Toby said that people are typically moving to the US later. There's probably a bit of caution out there in the market, and perhaps something to do with the size of funding rounds. And of course, the US investors are coming over here, so that might have something to do with it. And Toby said moving to the US is probably the hardest thing your company will ever do, and the timing is the big crucial thing to look out for. So really think about that in great detail. Now, there's 5 models of internationalization. You can go straight to the US like Zendesk, Stripe, or Datadog. You can go adjacent first to geographically nearby countries, such as what Unity did, UiPath and Mimecast. You can also do the team and business model, non-obvious territories such as Personio and Odin. There's the globally distributed model that HubSpot did, Typeform, and there's the inorganic strategy that many insurtechs have done. And in terms of the reality about what it's like in the US, you probably need to move there. At least one founder needs to move there. Remember, it's not the land of milk and honey. Hiring is hard, retention is hard. There aren't investors around every corner. It's not necessarily going to be easy. And the other thing is you need to look and feel like a US business in order to be relevant to the customers there. So that takes some thinking through. And you might have to go on your go-to-market fit journey that you went on before, let's say in Europe. And as we said at the end there, it feels like starting an entirely new business. So don't take that decision lightly. Look, Toby, that's fabulous. Is there anything else you would add to that summary?
No, I think you nailed it, Alex.
Fabulous. Great. Well, where can we find Ox and you if we want to get more of these pearls of wisdom and perhaps send you a deck or two?
Yeah, sure. I think the best way to reach out to me is on LinkedIn. I'm very responsive there, and I get back to everyone who reaches out. So that's probably the best place to find me.
Fully agree with that. Look, we can only thank you again for coming on the show. It's been a truly unique episode. So thank you once again.
Thanks, Alex.
That's all for this episode. Keep tuning in for more exclusive insights from seasoned investors, accomplished entrepreneurs, and professional service advisors. Follow the Tippy Top blog on all major social media platforms, including Twitter, TikTok, Insta, Facebook, or now Meta, LinkedIn, and of course, you can find me, Alexander Lee, on LinkedIn, and you can also check out my website, thetippytop.com. Until next time, keep pushing, and I'll see you at the Tippy Top.